Okay, this is the second podcast on Chapter 14, which is on the foreign exchange market. Let's go ahead and take a look at transactions in the foreign exchange market. There are three different types that can occur. The first one is a spot transaction, the second is the forward transaction, and the last one we're just going to do a definition on, which is a swap transaction. So the most simple transaction is the spot transaction. And what happens is in the interbank market, there is a purchase of foreign exchange, and the delivery and the payment of that foreign exchange will take place normally on the second following business day. So another way of saying that is that we enter into a transaction to go ahead and buy or sell foreign currency today, and within 2 business days, on that second business day, we will go ahead and we will take delivery and payment for that foreign exchange transaction. That's what we call the value date, the settlement date. And if we were to go ahead and to draw it out, it would look like this. So a spot transaction would go ahead and would occur today, and it would settle either the following business day or one day after. An overnight transaction would basically occur within 1 business day. A forward transaction and a swap transaction, these will take a longer period of time to go ahead and settle once they've been entered into. Okay, so the next transaction we'll look at is an outright forward transaction. Again, this is where there will be a delivery of that currency at a future value date for a specified amount of another currency. So we enter into the transaction today to buy or sell foreign exchange, and that will take place at some future date. So that could take place a month from now, 2 months from now, 3 months from now. It could go all the way up to 12 months or greater, basically. So the payment and delivery will not be required until that maturity date takes place. However, we go ahead and we agree upon the exchange rate today. Again, the currency will be bought or sold at some time in the future. Okay, a swap transaction is in the interbank market, and it's the simultaneous purchase and sale of a given amount of foreign exchange for 2 different value dates. So in this transaction, you're doing both a purchase and a sale of one particular currency. Both the purchase and the sale will be done with the same counterparty. That means you do it with the same individual or the same institution for both the purchase and the sale of the security of the swap. There are 3 different types of swaps. There's what's called the spot against the forward. There's the forward against the forward, and there's the non-deliverable forward. This is the only one I want you to know a little bit about. So you should know the definition of a swap transaction. A non-deliverable forward basically will be done in U.S. currency only, or it will settle in U.S. currency only, and it's usually done with emerging market currencies or currencies that cannot trade. There's a foreign exchange restriction on the trade. These will typically be done in an offshore market. And what happens is, let's say you're looking to hedge the value of the Chinese currency, and if there are foreign exchange restrictions that say that you can't go ahead and buy or sell, which is the case, then what you do is you look at where the exchange rates are of that RMB today versus where they're going to be in the future. You look at what the difference is, and then you would settle on the difference between the swap rates in US dollars. So it's typically started out being done for hedging purposes. However, now that's a very large market for speculative types of transactions. How big is the foreign exchange market? Well, as of April of 2013, the daily global net turnover is about 5.7 trillion US dollars a day. That's huge. We're looking at 2017 today. It's going to be upwards of this 5.7 trillion amount. The United Kingdom and the United States make up roughly 60% of the foreign exchange market, so just those 2 countries. However, the Asian markets are growing more rapidly than the European markets. If we were to look at the types of transactions that are being done on a daily basis, If we look at it over a yearly period, we can see that it was quite small in terms of what the daily volume was in 1989, all the way up to April 2013 of 5.3 trillion. Notice that FX swaps, which is the red, and spot transactions make up the majority of the transactions. And that's held pretty constant throughout the years from a period of 1989 to 2013. The top 10 geographic centers in foreign exchange marketing, look at the amount of transactions that the United Kingdom does. They're noted in blue. Their volume has increased tremendously over the years. So we're looking at about 500 billion to currently in 2013 of about 2.7 trillion. The United States would be next after that. They're denoted in red, but you can tell that they're quite a bit smaller than the amount of currency foreign exchange transactions that occur in the UK. And then all other countries, you could tell, are quite a bit smaller than the US and the UK. So again, that's correlating back to this bullet point here. The United Kingdom and the United States make up roughly 60% of the foreign exchange market. Okay, if we were to look at the transactions that are done, the US dollar versus other currencies makes up about 85 or 86% of all transactions as of 2013. So if we were to look at trading, let's say, between the US dollar and the euro, that makes up about 24% of all transactions. The US dollar with the Japanese yen is about 18.3%. The approximately 6% is done between the euro and other currencies. So euro and the Japanese yen is about 2.8%. The euro and the British pound makes up 1.9, etc. All other currencies, that is, all other currencies outside of the US dollar and the euro, make up about 8% of all the transactions. So you can see the US dollar and the euro really dominates the currency trading. A foreign exchange rate then can be defined as the price of one currency expressed in terms of another currency. It's sort of like if you go to the store and you're going to buy a pound of, let's say, turkey. A pound of turkey meat may be quoted as $6.99 for 1 pound of turkey. A foreign exchange quotation then is a statement or a willingness to buy or sell at an announced rate. So some of the more common currencies are, again, the US dollar, the symbol everyone knows as the dollar sign, and that code is the US dollars. The euro has the E with the two little funky marks in the middle, and we denote that as EUR. Great British Pound has the pound symbol, and GBP stands for Great British Pound. Japanese yen, and then the Mexican peso are other common abbreviations that we see out there. An interbank quote would be a bid or an ask price. So the bid price is the price at which a dealer is willing to buy another currency at. B is for the bid is for buy. The ask is the price at which a dealer will sell another currency. So I like to think of it as the S in the ask pertains to selling another currency. Now this is from the dealer side. So the dealer will go ahead and buy at the bid, but they will sell to another party at what the ask is, and vice versa. Dealers then make their profit from the difference in the bid and the ask spread. And again, a bid for one currency is also the offer or the ask for the other currency. And this is how we typically would see currencies quoted as. So, for instance, we can see that the Argentine peso, which the symbol is P dollar sign with the code of ARS for Argentina, the US dollar equivalent would be 0.1526. So if you wanted to buy one Argentine currency, it would cost you 0.1526 cents. So for one US dollar, then it would be worth $6.55 Argentine. In the third podcast, we're going to get more into how the foreign exchange rates are quoted. But again, this is just typical of how it would look. Okay, so again, US dollar equivalent for one Argentine dollar is about 15 cents, or you can get about 6.56 Argentine dollars for $1 US. That will end the second podcast.